I'm Ross Walker, Chief UK Economist at NatWest Markets. So the Bank of England left interest rates on hold at 0.75% in January. What had seemed ahead of the meeting to be quite a closely balanced decision, in the end saw much less change in terms of the Bank of England's policy signalling. Their forecasts factor in a little bit of policy loosening, around 10 basis points of interest rate cuts in the first couple of years. But on their projections, that's enough to push inflation above its target at the 2 to 3 year horizon. So implicitly, the signal from the Bank of England is that although they've been edging a little bit closer towards an interest rate cut, they didn't move decisively in that direction in January. And for now, the message from the central bank seems to be that rates will remain on hold for several months. The thing that will change, certainly, at the next Bank of England policy meeting is that there will be a new Bank of England governor, Andrew Bailey, replacing Mark Carney. Now, Andrew Bailey has been at the BOE since the mid-1980s, but we don't know a great deal about his views on monetary policy because for most of that time, certainly over the last couple of decades, he has been very much on the financial stability rather than the monetary policy side of the bank. So there really isn't very much information by way of quotes, commentary on the wider economy from him. So perhaps surprisingly, counterintuitively, he is a little bit of an unknown quantity in monetary policy terms. The other point to emphasise is that the bank's rate setting committee, the MPC, is very much a committee of 9 individuals who vote individually on monetary policy, who are individually accountable. It's not a collective consensus-seeking body dominated by a governor in the way that some other central bank policy committees are. So I'm not sure Mr. Bailey's arrival really will mark any significant change in the BOE's direction. And so markets are waiting, obviously, for his first keynote policy speech, but also some sense of how the other 8 members, how their thinking is evolving on the wider economy. So in addition to central bank meetings in the spring and summer, which markets will be watching closely for possible interest rate cuts, we also in the UK have the budget on the 11th of March, and a significant policy change is expected there. The UK, for the first time in many years, the best part of a decade, is embarking on an expansionary fiscal policy stance. So primarily extra public spending targeted at areas like healthcare, policing, also some extra public sector investment spending on infrastructure, roads, rails, etc. And probably some modest tax cuts as well, targeted at lower to middle earners following the election victory of the Conservatives. So an expansionary fiscal policy. In aggregate, we think this could be at least 0.5% of GDP, up to 0.75% of GDP. So in other words, up to half of the overall economic growth we expect to see in the UK in 2020. And in addition to the fiscal stimulus, the detailed policies that will be announced for the coming financial year beginning in April. The government will also publish its medium-term tax and spend projections. So we'll also get a much clearer sense of how the new government plans to set fiscal policy over the next 4 or 5 years. And Brexit, of course, remains a major issue for the UK this year. The Prime Minister delivered a keynote speech at the beginning of February, setting out his vision for the UK's future trade deal with the EU. The negotiation window is quite tight. A deal has to be agreed and ratified before the end of this year if an extension is to be avoided or a no-deal outcome is to be avoided. That is probably doable, but I think it will constrain the type of deal the UK can get. That limited time frame, 9 months or so to complete the process, alongside some of the UK's red lines in terms of what would be an acceptable trade deal outcome, mean that I think all the indications are that the trade deal the UK gets with the EU will be pretty basic. It will be limited to, I would imagine, tariff-free, quota-free trade in goods, manufactured products, some agricultural products, but probably very little, if anything, on future services arrangements. So this trade deal is probably best thought of as the first stage in a series of ongoing trade negotiations between the UK and the EU. That might cause some disruption in the near term, create some uncertainty for UK businesses, hold back investment and hiring plans. And so we will have to see how the longer term picture evolves. But probably a deal before year end, but a very tight deadline, still some uncertainty, and probably still some headwinds for the overall UK economy. Thank you for watching, and please stay tuned following us on social media.